Welcome to Beyond the Comfort Zone Talking Shit with KING-KAMBUF. If you're here, you're looking to get past the daily noise and really get into the mechanics of what's driving the market.
That's the goal.
Today, we are doing a deep dive into your source material. We're looking at the Reserve of KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis.
Specifically the daily report.
Right, the daily report covering the action from December 4th and 5th, 2025. And we're going to try and put that whole week into context.
And our mission today is pretty laser focused. We want to cut through all that noise, synthesize the big financial narratives, and really deliver those actionable insights.
Especially that proprietary analysis from the TKIF 20+ system.
Exactly. We need to give you the full picture, the full context of what was driving the market as we, hurtled into the final month of 2025.
And what we found in these reports is, well, it's defined by this massive conflict, this grinding friction.
It really is.
So here's the snapshot that just immediately grabbed my attention. We closed Friday, December 5th, with U.S. stocks, edging higher.
A green day.
A green day. The big indices, the S&P 500, they were feeling optimistic, actually getting close to that all-time high mark again. It feels triumphant.
It does. But then you follow the system, you zoom out just 5 days, and that entire picture just reverses. It reveals all this underlying market stress.
A completely different story.
Completely different. So while Friday was green, the overall week, December 1st through the 5th, it showed some really significant structural declines.
Like what?
The Nasdaq Composite was down a massive 2.70%. That's almost 500 points gone.
Wow.
And the S&P 500 wasn't far behind, down about 1.97%.
Okay, let's unpack this. This is the core contradiction. It's the very definition of market friction, right? How can you have this triumphant Friday and then suffer such a brutal weekly correction?
And that divergence, that daily positivity versus the weekly correction, that is the central theme of this whole week's analysis. It says so much about where investors are positioning themselves.
So what's the driver?
The Friday optimism was, it was purely forward-looking. It was all driven by this hope that a fresh, kind of slightly encouraging inflation report.
Right.
It gave the Federal Reserve cover to maybe signal some rate cuts in 2026. The market was looking 6 months down the road.
So if Friday was all about future optimism, what was driving the deep weekly declines? What was that about?
That was about the present reality. It was about the structural headwinds. We saw aggressive, systematic profit-taking, mostly in technology and semiconductors, the stuff that had run up so much earlier in the year. But the primary driver, the real heavyweight, was the bond market.
The 10-year Treasury.
The 10-year Treasury, stubbornly sitting at 4.09%. And that high interest rate environment, it just acts like this heavy, constant drag on equity valuations.
Especially those high multiple growth stocks in the Nasdaq.
Especially those. That 4.09% yield makes the future earnings of those companies significantly less valuable today. So analyzing that friction, that optimism versus the high rates, that's really the core task of this deep dive.
Okay, let's start where the report does, with the immediate relief of Friday, December 5th. I mean, after 4 days of heavy selling, that close must have felt like a positive return to form for the bulls.
So, absolutely.
Can you tell us exactly how the indices stacked up?
Yeah, it was measured, but a definite rebound. So you had the Dow Jones Industrial Average closing at 47,954.99. Right. That's a gain of 0.22%. Yeah. The S&P 500, which is the index we use as our main barometer,
right,
it closed at 6,870.40, a 0.20% gain. And like the report noted, this close put it crucially close to establishing a new all-time high.
Which is a huge psychological victory for the bulls.
Huge. And the Nasdaq Composite, even with all its weekly suffering, it still managed to close in the green at 23,578.13, up 0.30%.
And that momentum, it was definitely tied to all the chatter about monetary policy. We saw that fresh inflation report. It showed a slight, manageable rise in consumer prices.
It did.
Now, for the average listener, that might sound bad, right? Inflation rising. But in the context of the Fed's fight, why did that moderate increase suddenly fuel these rate cut hopes for 2026?
Well, the market narrative right now is it's incredibly nuanced. A massive drop in inflation might signal a recession, which forces the Fed to cut rates, but that comes with a lot of economic pain.
Sure.
On the other hand, spiraling inflation means the Fed has to hike rates, or at least hold them higher for longer, and that just crushes growth valuations.
So this was the sweet spot.
This slight rise was interpreted as the Goldilocks scenario.
Exactly.
Inflation is decelerating enough that the Fed can soon, declare victory, but the economy isn't collapsing. A soft landing is possible.
So the market is just betting that the Fed can afford to be more dovish next year.
Precisely. And since the market prices in the future, lower rates in 2026 translate directly into higher stock valuations today.
But we can't just stay focused on Friday. We have to pivot right away to the full weekly context from the KING-KAMBUF report, because that's where the real story is, the pressure on investors.
And that weekly data is where you can see the friction. I mean, the correction was far from trivial. The S&P 500 dropped nearly 2% for the whole week. That's a loss of 112.37 points.
And the Nasdaq was even worse.
So much worse. As we highlighted, the Nasdaq Composite, our proxy for high growth in tech, it declined a staggering 2.70%. It lost 481.04 points. That's a heavy, painful deleveraging event.
And you said the main driver was that 10-year Treasury yield of 4.09%. For our listener who might not, live and breathe bond math.
Right.
Can you explain conceptually why the difference between, say, a 3.5% yield and a 4.09% yield can create so much pain in the stock market, especially for tech?
Sure. It fundamentally changes how we value a company. Think of it like this. When you value a growth company, you're valuing its future profits that might not even show up for 5 or 10 years. To figure out what those future dollars are worth today, you have to discount them back using an interest rate, or in this case, the risk-free rate, which is approximated by the 10-year Treasury.
So when that rate jumps
from 3.5% to over 4%, the discount rate gets dramatically higher. Those promised future earnings, which are sometimes just, projections on a spreadsheet, are suddenly worth significantly less in today's dollars.
And that forces valuations down.
It forces valuation compression, which means stock prices, especially for companies that don't make much profit yet, they have to fall. And that's why the Nasdaq always gets hit the hardest.
That context is just vital. And this structural pressure, it wasn't just in the mega caps, right? The report also flagged pressure on small caps.
Correct. The Russell 2000, which tracks the smaller U.S. companies, was down 2.05% for the week.
That's a broad.
It indicates a very broad market pressure that isn't just about unwinding mega-cap tech. It's about a wider de-risking environment. And when the 10-year yield is above 4%, investors demand higher compensation for taking on the risk of these smaller, less established companies.
Which leads us right to the market's psychological barometer, the CBOE Volatility Index, the VIX.
The VIX.
gauge.
Yep.
And we have two conflicting VIX numbers in the reports. Friday's close was 15.61, down over 1%. That suggests calm.
Right.
But the weekly analysis flagged the VIX as elevated. How do we reconcile that?
That is the perfect illustration of market schizophrenia. The daily VIX dip to 15.61 just confirms the Friday risk-on mood. People weren't panicking about what was going to happen over the weekend.
They felt safe enough to hold their positions.
Exactly, based on that whole Fed narrative.
But the elevated weekly reading, that tells a different story about the medium term.
A completely different story. The VIX measures expected 30-day implied volatility. So when the weekly report calls it elevated, it means investors are pricing in moderate to higher volatility over the next month, despite that calm Friday close.
And we've defined this before. A VIX around 20 to 25 suggests what?
It suggests an expected 5.8% to 7.2% movement in the S&P 500 over the next month. So that elevated weekly sentiment, it's a warning that the underlying turbulence, the bond yield risk, the year-end positioning uncertainty, all that profit-taking hasn't gone away.
It's an urgent signal.
It's an urgent signal to maintain a cash buffer and be really careful on any big purchases. The market expects this fight to continue.
Okay, let's move from the pressure of the macro indices to the really exciting company-specific news that just dominated the feeds on Friday. And this is where it gets really interesting.
Agree.
Let's talk about the largest corporate headline of the week, the proposed Netflix and Warner Bros. Discovery mega merger.
This deal is just monumental, and it's so strategic. Netflix announced its intention to acquire Warner Bros. Discovery WBD, in a deal that analysts are valuing at over $72 billion.
Wow.
And it's being paid for in a mix of cash and stock. This isn't just a big acquisition, it's a tectonic shift in the streaming wars.
And you could see the gravity of it in the market reaction. WBD was one of the single most active stocks on Friday. It traded over 113 million shares.
That volume just confirms the conviction. You can almost picture the trading screens going crazy as institutions tried to price this thing in.
So what are the repercussions?
Profound, immediate repercussions for the whole streaming landscape. What Netflix gains here isn't just subscribers. It's content depth and market dominance. You consolidate that massive content library, you remove a major competitor, and you instantly create an undisputed market power.
And that puts pressure on everyone else.
Everyone, Disney, Comcast, Amazon, the new entity's ability to price, to bundle, to retain content, it suddenly becomes incredibly strong.
So is this a defensive move by Netflix, or is it pure expansion?
I think it's likely both, but it's primarily defensive consolidation. I mean, the streaming war was getting so expensive.
Billions on content.
Billions on original content just to keep up. So by removing WBD, which owns these enormous back catalogs, and IP Netflix drastically reduces its long-term content acquisition costs, it gains massive scale, and critically, it increases its bargaining power with talent and producers.
It's a move toward profitability through consolidation.
That's what mature industries do.
Right. Okay, so moving from streaming giants to a really unexpected new heavyweight in the index, Carvana. This piece of news seemed to catch Wall Street completely off guard.
Absolutely. Carvana is slated to join the S&P 500 index, along with 2 other companies, effective soon. And this was genuinely surprising.
Why?
Because, many had earmarked larger, arguably more stable or established tech names for inclusion. Carvana's had a highly volatile past, so its inclusion just signals that the index committee is prioritizing market cap and liquidity over historical stability.
Okay, so if I'm an investor and I'm running an index fund or an ETF that tracks the S&P 500, what's the practical, immediate implication of Carvana being included?
It's forced buying, or what we call mechanical buying.
Mechanical buying.
Index funds, ETFs, they're passive vehicles.
Yeah.
They have to accurately mirror the composition of the index they're tracking. So this means they have to sell the company that's leaving the index and buy a predetermined number of shares of Carvana.
And that creates a demand surge.
It creates an immediate, concentrated boost to Carvana's stock price, often regardless of its recent operational performance. It's a major technical tailwind that can last for several days, even weeks, until that rebalancing is complete.
Let's circle back for a second to the core economic driver for Friday's positive sentiment, inflation and the Fed. We know the slight rise in consumer prices fueled those rate cut hopes for 2026. What does that tell us about the market's current priority?
The market's priority is simple: avoiding a policy error. That slight rise in consumer prices didn't eliminate the need for rate cuts, but it did confirm that the economy isn't just crashing into a wall. It strengthened the soft landing narrative.
So if prices had plummeted, that would have been bad news.
Very bearish. It would signal demand destruction, potential recession. But since the rise was slight, the market bought into this idea that the Fed has successfully engineered a glide path where inflation returns to target without massive job losses.
And lower rates, even a year out, that's what matters.
It massively outweighs the current inflation fear in the eyes of equity investors.
Was there any other specific sector or company that really demonstrated this highly selective strength, especially in the face of broader retail weakness?
Yes, Ulta Beauty. It was the standout retail bright spot. They surged after reporting better-than-expected quarterly results and, this is the key part, raising their full-year revenue forecast.
And what signal does that send to you, the listener?
It's a very clear signal. Consumer spending isn't dead, but it is highly, highly selective. Consumers are favoring these niche, experience-based, or high-conviction brands like Ulta over the broader apparel or general merchandise chains.
Which showed a lot of weakness.
A ton of weakness throughout the week. You had stocks like PVH Corp hitting 52-week lows. It's a very bifurcated market.
Okay, let's get granular now and look at the actual volatility, which is so essential for understanding where the speculative capital is flowing. We saw mixed signals even before the opening bell on Friday, December 5th.
Yeah, that pre-market snapshot is always important. It really sets the emotional tone for the day.
What did we see?
The early gainers included Metavia Inc., that's MTVA, and SMX, which is Security Matters. On the losing side, we saw pressure on Coin Pharmaceuticals, QNRX, and Sportsman's Warehouse, SPWH.
So what does that tell you?
It tells you that even with a potentially positive macro day ahead, stock-specific news was still dominating. Clinical trial update for a pharma stock or a pre-announcement warning for a retailer.
But the real spectacle, the real show, came once the bell rang. We have to dissect the daily extremes because the volatility was just massive. It reveals this extreme risk appetite in the small-cap, low-float stocks.
We saw movements that you just do not see in blue-chip names. The top gainer, SMX, Security Matters, public limited company, it exploded by an astonishing plus 173.05%.
173% in one day.
In one day. This level of hyper-speculative action is usually driven by a very low share float, meaning a small amount of buying can just rocket the price up,
Right.
or some very specific news catalysts that institutions haven't priced in yet.
Any other big ones?
Oh yeah. Treasure Global Inc., TGL, was up over 104%, and iRobot, IRBT, gained nearly 40%. This is the lottery ticket segment of the market in full swing.
And on the losing side, the carnage was just as dramatic. It reflects these catastrophic stock-specific failures.
Absolutely. Smart Digital Group Limited, SDM, collapsed by a brutal 86.41%.
86%.
When you see that level of immediate total collapse, it almost always points to an event like a complete failure in a clinical trial, a catastrophic earnings miss, or severe dilution where the company just floods the market with new stock.
Instantly destroying shareholder value.
Instantly. AHMA was down over 33%, and Sportsman's Warehouse, SPWH, fell 31.02%.
Okay.
Which just reinforces that ongoing weakness in the retail and consumer space we talked about.
So to understand the momentum that feeds into the TKIF analysis, we need the context from December 4th. We need to see where the heavy selling was happening just before Friday's rebound.
And that December 4th report clearly showed the preceding day's tech profit-taking was acute. I mean, while UiPath was an outlier, leading gators at over 22%, which foreshadows its importance.
Right.
We saw some really painful tech losses. Snowflake, SNOW, a bellwether for cloud data, dropped 11.18%. This just reinforces the pain of that weekly correction. Investors were systematically exiting expensive cloud and software names earlier in the week because of those high bond yields.
And the trading volume, that confirms where the highly speculative money was moving.
Extreme volume confirms extreme conviction, or extreme speculation. You had PAVS, Paranovas Entertainment Technology, which saw astronomical trading volume, 748 million shares traded on Friday.
748 million.
And 175 million the day before. That much volume in a single lower-priced stock is generally indicative of a massive short-lived retail and speculative frenzy.
And WBD was different.
WBD's 113 million shares traded on Friday was purely institutional. That was directly attributable to the market reacting to that Netflix merger announcement.
This volatility, it brings us to what I think is the single most important structural trend revealed by these reports: sector rotation.
Yes.
The 52-week highs tell us exactly where institutional money is relocating to find safety in yield.
And what's fascinating here is what was strong on Friday, despite all that weekly pressure. We had blue-chip names hitting new 52-week highs: Walmart, Bank of America, Wells Fargo, BHP Group, and Caterpillar.
That list is the complete antithesis of the growth stocks that led the market for the last year. It just screams value and cyclical stability.
Precisely. This is a deliberate, calculated rotation. Money is being pulled out of those volatile, high-multiple growth names, the tech sector, and being strategically redeployed into three key areas.
What are they?
First, financials. Bank of America, Wells Fargo. They benefit directly from higher interest rates because they can charge higher net interest margins on their loans.
Okay.
Second, defensives and value. Walmart. It holds up regardless of the economic cycle. And third, industrials and materials. BHP, Caterpillar. They benefit from physical economic activity, global infrastructure, and they're a hedge against inflation.
So we're seeing the strength in those sectors just confirm the weakness we observed in technology and software.
Exactly. The weakness is concentrated where the valuation risk is highest. We confirmed stocks near 52-week lows in tech and software like Intel, trading at $40.93, dangerously close to its yearly low.
Any other weak spots?
Biotech, with Unicor, also showed significant pressure, as did retail. This is a textbook risk-off move where traders sell the most expensive, most rate-sensitive stocks and buy these staple cyclical hedges. And the resilience in energy, too, that was noted in the December 4th report, names like APA Corp and TXNM showing strong momentum, that further confirms this movement toward physical asset exposure and inflation protection.
All right, now we move into the proprietary heart of the report, the TKIF plus analysis. But before we dive into the specific picks, we have to establish the fundamental backdrop. I mean, all the technical momentum in the world needs a foundation, and that foundation is earnings.
That is a crucial caveat. The market can handle a correction, but it can't handle earnings disappointment. Fortunately, the fundamental story remains surprisingly strong.
How so?
The third quarter 2025 earnings season was robust. S&P 500 companies reported year-over-year earnings growth of 13.1%. That provides the structural ballast against the technical pressure we've been discussing.
And the future outlook remains incredibly optimistic.
Highly optimistic. Analysts are predicting 11.7% growth for the full year 2025, and an even stronger 13.9% earnings growth forecast for 2026.
Wow.
This is the underlying bull case. If the market can sustain that kind of double-digit earnings growth, then the current volatility is just a speed bump. It's a necessary cleansing of excess speculation.
We should probably mention some of the specific earnings reports that provided important catalysts during the week.
Yeah, we had a mixed picture that really highlights the volatility. Macy's posted its strongest growth in 3 years, but critically issued a cautious outlook for the holiday season.
So management is hedging its bets.
Exactly. Hewlett-Packard Enterprise missed revenue expectations, citing weak server sales, which speaks to broader corporate tech spending issues, another pressure point for the Nasdaq Q.
And Southwest?
Southwest Airlines had to cut its earnings outlook, not due to a market failure, but due to external demand hits from the government shutdown, a completely unpredictable factor impacting their profitability.
This volatility, these results, this macro tension, it all feeds into the proprietary KING-KAMBUF Plus system. For our listener, can you give a better conceptual definition of what this system is looking for beyond just charting?
Of course. The KING-KAMBUF 20 Plus system is a multi-factor quantitative model. It synthesizes momentum, institutional volume profiles, and proprietary sentiment indicators over a rolling 20-day period. That's the 20 plus part.
Okay.
It's focused on identifying high-probability setups, specifically looking for optimal entry and exit points coupled with calculated spread opportunities.
So the potential profit margin.
A potential percentage difference between the entry price and the take-profit target, yes. It screens out the noise to find where genuine institutional buying power is confirming a breakout. And the resulting analysis guides both conservative holding and more aggressive day trading strategies.
Perfect. Now let's dive into the detailed breakdown of the top 5 stocks identified by the KING-KAMBUF system, starting with NVIDIA. I have to ask, given the 2.70% Nasdaq Q drop and Intel being so close to its 52-week low, isn't recommending a fresh entry on NVIDIA right now inherently risky? Why is the system so confident?
That is a critical challenge, and it goes right back to the system's focus on institutional conviction. NVIDIA is the anchor trade, precisely because it defines that sector weakness.
So what are the numbers?
The current price was $184.08. The system identified an optimal entry zone between $180 and $182, a slight dip from the Friday close, which signals patience.
And the target?
The strong price target ranges from $200 to $210. This gives an attractive spread potential of 9.8% to 15.2% upside.
What's the rationale?
It's the undisputed AI dominance and the massive institutional support, which you can see in the 91 million shares traded. The report classifies the risk level as medium, because while the general sector is shaky, NVIDIA is treated like an essential utility and must-own in any growth portfolio. The system is betting on rotation within tech, not out of NVIDIA entirely.
Okay, next, let's look at the high conviction momentum trade, UiPath. This stock already surged over 22% on December 4th. I mean, chasing a 22% move usually ends badly for retail investors.
It often does.
So what gives the KING-KAMBUF system the confidence to call this a primary trade?
Path is a classic high-velocity breakout play that the system has validated with volume confirmation. And the system avoids chasing the peak by setting the optimal entry slightly lower, between $17.50 and $18.
So it's anticipating a pullback.
It's anticipating a necessary slight pullback or consolidation period. The projected price target exit of $21 to $24 gives a massive spread potential of 16.4% to 32.9% upside.
And what's driving this trade?
The automation software tailwinds, a key growth area, and strong earnings expectations that clearly beat the market consensus. But because of that rapid price appreciation, the risk level is deemed medium-high. It demands strict discipline and adhering to the stop loss.
Then we have AST SpaceMobile, ASTS, showing strength in that speculative high-growth area of satellite and space tech.
Yeah, ASTS had strong momentum. It was up 18.56% to a current price of $72.90. The KING-KAMBUF targets a range of $85 to $95, providing a 15.6% to 30.1% upside potential.
And the rationale here?
It's sectoral. It's exhibiting strong leadership within the space technology segment, and the system notes it has significant room to run back toward its 52-week high of $102.79. It's classified as a medium-risk play focused on capitalizing on that speculative growth driven by technology milestones.
Okay, moving to energy transition, we have Fluence Energy, FLNC. It has exceptional spread potential, which confirms that money is flowing into cyclical energy plays.
FLNC is a great example of capitalizing on that sector rotation we discussed. It was up over 17%. The optimal entry was set between $22.50 and $23.50, with ambitious targets between $28 and $32.
And the upside potential on that is?
It translates to an upside potential of 21.5% to 38.6%. Its success is tied directly to that strong energy transition, tailwind infrastructure, battery storage solutions, and the fact that it is trading near 52-week highs, which confirms market confidence.
And finally, BigBear.ai, BBAI, which offers the highest potential upside among the top 5, but I'm guessing it also comes with the highest risk.
It does. BBAI is the highest risk-reward trade in this batch. It's classified as medium-high risk.
What are the numbers?
Its current price was $6.79, and the system projects targets between $9 and $10.50. That offers a truly exceptional upside potential of 35.7% to 52.2%.
And why is the system so bullish here?
It's the unique dual exposure. It's a pure-play AI application company, but it's combined with defense contracts, which offers resilience and government spending visibility. And this setup is backed by exceptional, validating trading volume over 70 million shares. The system identifies this as potential multi-day breakout if that volume sustains.
The KING-KAMBUF system also provides day trade projections, the highest conviction intraday trades, which require impeccable timing and iron discipline. For the person trying to digest this at home, what exactly is the practical difference between a strong buy like UiPath and a regular BUY like AS in the system's eyes?
The difference is the probability of success based on the KING-KAMBUF metrics, specifically the confluence of momentum and low short interest. Path was designated a strong BY with a 70% plus win probability.
So maximum conviction.
Maximum conviction. The system believed the technical signals were overwhelmingly bullish. ASTS was a high probability BUY with a 65% plus probability, still high, but slightly less certainty.
And both require extremely tight risk management.
Absolutely. For Path, the entry was $17.50, $18, and crucially, a tight stop loss at $16.50. For ASTS, the stop loss was $68. For these fast-moving momentum plays, defining that stop loss before you even enter the trade is non-negotiable.
It protects your capital.
It protects your capital from swift reversals. The system prioritizes protecting the downside, even on its highest conviction plays.
The KMBUF report distinguishes clearly between two primary portfolio strategies for different risk tolerances in this high-friction market. Let's look at the conservative portfolio recommendations first. Preservation of capital has to be paramount when the 10-year yield is above 4%.
It has to be. The conservative strategy is designed for exactly that, capital preservation, while still capitalizing on undeniable fundamental strength.
So what's the core position?
The core position is a significant allocation, 15% or greater, to NVDA. This is treated as a foundational long-term AI play. This concentration risk is then balanced with a defensive stability play, specifically Walmart, WMT.
Which acts as a counterbalance.
A crucial counterbalance against economic uncertainty. It also provides reliable dividend support. But most importantly, the conservative investor is advised to maintain a substantial 20-25% cash reserve.
And that cash isn't just sitting there.
No, it's not idle. It's reserved for opportunistic buying during unexpected market pullbacks, recognizing that the volatility creates great entry points.
And then we have the approach for the high-octane, aggressive, or day trader portfolio, which sounds like it's designed to attack the volatility.
This strategy is all about maximizing exposure to momentum and high-spread potential. The primary focus, naturally, is UiPath, due to its highest conviction ranking and that explosive recent move.
And the secondary focus?
Secondary focus rotates into the other high-upside trades identified by KING-KAMBUF, ASTS, FLNC, and BBAI. And then finally, there is a speculative tier, including Rigetti Computing, RGTI for exposure to quantum computing, and Axogen AXGN for the medical device breakout.
And this strategy relies entirely on technical discipline.
Entirely. Strict entries, aggressive profit-taking, and unwavering stop losses.
Okay, let's synthesize the technical setup observations outlined in the report, starting with the bullish signals. After that brutal weekly decline, what evidence do the analysts have to maintain any optimism for the short-term future?
Well, the optimism is grounded in tangible trading signals that suggest this is consolidation, not a collapse. First, the report highlights that multiple stocks, Path, ASTS, FLNC, BBAI, are breaking key resistance levels. And this is happening with strong volume, which validates the price action and suggests institutional support. Second, we have clear evidence of sustained institutional buying in key AI-related names, exemplified by NVDA's massive volume. And third, the stability and proximity to 52-week highs in the energy sector confirm that money is flowing somewhere productive. It signals sector rotation rather than a total indiscriminate flight from all equities.
But those bearish signals provide the essential counter-narrative. They reflect the fear that's priced into that elevated VIX reading.
And that bearish friction is substantial and it's persistent. The number one headwind remains the higher bond yields. That 4.09% 10-year yield makes fixed income a genuinely attractive alternative to the volatility of equities.
Especially for large institutions.
Exactly, for pension funds, large institutions. And although NDDA is strong, the broader chip sector is showing selective weakness, indicating that not all tech is being treated equally.
A clear sign of risk-off sentiment.
It is, in second-tier tech. And finally, there's the psychological factor. December is notorious for profit-taking and tax loss harvesting, which creates expected high volatility throughout the final weeks of the year.
For the listener managing their own positions, what are the critical price points, the key levels to watch, that determine if the bulls or the bears are winning this structural fight? These are the tripwires we need to monitor.
These levels are non-negotiable. For the S&P 500, holding support at 5,500 is absolutely necessary. A break below that level would signal a deeper technical breakdown and would likely trigger mass selling.
And the upside.
Conversely, resistance at 50,700 is the key level bulls must breach and hold to confidently resume that all-time high attempt fueled by the 2026 rate cut hopes.
And for the battered Nasdaq Q.
The Nasdaq Q needs to stabilize and hold support at 17,000. If 17,000 fails, we could see a dramatic retest of mid-year lows. Resistance at 17,500 would indicate a successful recovery from the recent tech weakness and renewed faith in growth.
And the external pressure is still the bond yield.
Crucially, if the 10-year yield exceeds 4.25%, that signals renewed and potentially severe pressure on all equities. It would trigger a significant technical reversal.
So based on all this data, the friction, the rotation, the high conviction picks, what is the short and medium-term market outlook from the KMBUF analysts?
In the short term, so the next 1 to 2 weeks, the outlook calls for continued high volatility, but with targeted sector-specific strength. We should see momentum continuing in the confirmed breakout names like UiPath and the defensive cyclicals like Caterpillar.
So the strategy is precise?
Very precise. Use pullbacks as buying opportunities for confirmed breakouts, not just indiscriminate dip buying across the board. For the medium term, so the next month, the report anticipates that year-end positioning will maintain volatility throughout December. The advice is to monitor earnings quality very closely and watch for clear stabilization in the broader tech sector versus sustained strength in energy and defensives.
So wrapping up this extensive analysis, what are the final actionable items for you, the listener, to take away from this specific report?
Caution and discipline are paramount, especially as we head toward those year-end liquidity concerns. The action items are clear. 1. Build positions in confirmed breakouts like UiPath, ASTS, and Fluence Energy using the system's specified entry points. Don't chase unvalidated moves.
2.
2. Maintain strict technical stops like the $16.50 off for Path to protect capital from the inevitable rapid volatility. And 3. Be disciplined in taking profits at the identified targets. Don't let greed reverse a successful trade, especially given the market's propensity for December volatility.
That was an incredibly detailed deep dive into the friction that's defining the beginning of December 2025. This report provided exceptional clarity on how technical moves are being shaped by these macro pressures. Let's quickly summarize the 3 most important insights we've extracted from the core of the Reserve of KAMBUF report.
First, it's that overarching conflict. The tension between the strong Friday close, which was all driven by optimism about 2026 Fed cuts,
Right.
and the deep structural weekly correction driven by that stubborn 4.09% bond yield and some severe tech profit taking.
Second, the strategic importance of that massive Netflix and Warner Bros. Discovery merger. It signals a new era of consolidation and pricing power in the streaming wars.
And third, the identification of those high-conviction momentum plays by the TKIF 20+ system. The phenomenal spread potential in UiPath, NVIDIA, and AST Space Mobile gave active traders clear, highly analyzed entry and exit points, all validated by institutional volume.
It's always fascinating to process this high-level data and see exactly how market mechanics are playing out beneath the surface headlines. Thank you for sharing your source material and allowing us to provide this analysis.
Before we wrap up, I want to leave you with one final provocative thought to mull over as you digest this high-friction environment.
Okay.
Given the robust predicted earnings growth for 2026, that forecast of 13.9%, coupled with the aggressive end-of-year profit-taking and the current high bond yields acting as a headwind, does the present rotation signal a healthy, necessary consolidation before a major market break higher in the new year?
Or is it something else?
Or are these underlying pressures merely a temporary pause before the big tech leaders reassert their market dominance, leading value and cyclical plays behind once again? What stands out to you?
Until next time, stay well informed and stay strategic.